Hi guys, you are welcome to our channel. This is your regular financial accountant and accounts teacher, Semo School. In our previous video, we discussed the trading accounts because we are looking at the final account of a sole trader. In the trading accounts, we were able to determine the gross profits. And so this gross profit you see here is gross profit from the trading account. So if you have not watched our video on trading accounts, we urge you to go and watch that video to understand the format for trading accounts. And that is what we want to continue. Now we want to continue with you understanding the profit or loss accounts, which is part of the complete accounts called the trading profit or loss accounts. So when you get your gross profits, you can see that the gross profit is basically determined by using the sales revenue, right? So the sales revenue was used to determine the gross profits. So the other incomes and gains that the company has realized or the entity has realized is not part of this gross profit. So once you determine your gross profit, then any other gains and incomes that you receive within the year, you add them to your gross profit. So one of the gains is rent receivable. So the rent receivable, we are looking at the entity has an asset. Okay, the business has an asset and it is renting this asset to other entities, which can be a car, which can be a building or any other assets. So when they rent those assets out, they get some income. But because they are not really into the business of renting asset out to people, they can't add that one to their sales revenue, right? So let's say the company sells, let's say they sells books, the company sells books or the entity sells books. Now, the money that they get from the sale of the books is termed as the revenue. But if that entity has a car and then they rent it out, it becomes what? It's an income. So that would be the rent receivable. So that rent receivable must be added to the gross profit. So let's use an example. Say rent receivable of 1,200 was realized within the year. And so here we are just adding the gains and then the incomes to the gross profit. Another gain and income item is reduction in provision for doubtful debts. So an entity makes provision for the debtors because the entity knows that not all debtors may pay their debts at the end of the year, or some of them may not pay at all. So per your records, if let's say 10% are not paying, then you have to make a provisions which is equivalent to that figure so that in case they don't pay, you have already prepared yourself for that danger. And this is in conformity to the prudence concept. So if your provision reduces, it becomes something which can be described as gain to you. Because let's say you have made a provision of say 1,000 cedis or $1,000 or £1,000. That is the provisions that you have made. And it happens that 900 didn't pay. So it means that you have excess of 100 because your provision has actually fallen. Okay, so the provision that you make, if it falls, if the provision falls, then it becomes a gain to you, which must be added to your gross profit. But if the provision increases, if your provision for doubtful debts increases, then it's no more a gain, but it will form part of these expenses down here. So let's assume a provision reduction in provision of 2,000. That one you add it, and then other income. So the income that you see here, this provision and this rents are not exhaustive. There are other incomes that we cannot present all of them here. So something like even discounts received, the discounts received can be here, which can be part of the other incomes. Okay, so any other income that the company realizes within or the entity realizes within the period must be presented here, or it must be added to the gross profit. So all other income must be added to the gross profit. So let's take for instance all the other incomes, 2,500. So these are the three items we have that we are adding to the gross profit. So gross profit of 38,000 added to this 1,200 added to this 2,000 added to this 2,500. So it's giving us 43,700. So this is the gross profits in addition to the gains and incomes that we realize within the accounting period. So once we have this, then we then go ahead to deduct our expenses we incurred within the year. And the expenses can be put into groups or into categories. We have the selling and distribution expenses, we have the general administrative expenses, we have the finance expenses. So all these expenses must be put together to be deducted from the this total income here of 43,700 for us to get our net profit. So let's look at the expenses. Selling and distribution expenses. So all expenses that we incurred, which are in relation to selling and distribution, must be put together. And a good example is discounts allowed. So those that came to buy from you, let's say the item's cost is 5,000, and then you sold it to them for 4,000, which means you are giving them a discount of 1,000, and so it becomes a cost because usually you give those discounts in order for you to sell more. So it's an expense which relates to selling and distribution, and so that expense must be also presented. So discount allowed, let's give it a figure, say 3,000, or say discount allowed of 3,000. We have bad debts. Maybe within the accounting year or within the period, you realize that, oh, about 4,000 or 2,000 or this number of customers did not pay. Okay, you have tried all means and have realized that they will not pay. Some of them, you can even take legal actions against them, they will not pay. Others too, it will be that the company or the entity has gone into bankruptcy, or the owner is dead, or the business has collapsed. Then the debt will become bad. And so once it becomes bad, it's part of your selling and distribution expenses, and it must be added to the cost of the entity and determine the profit. So let's assume there was a bad debt of 1,100 within the year. You present that one too. Another expense carried outwards. When we determine the trading accounts, we realize that there's something called carriage inwards. When you go and buy, and then we bring them into the company, the cost that we incur is the carriage inwards. In the same way, when the customers come and buy, we can tell them that, oh, free delivery. When you buy from us, we will deliver to your warehouse or wherever you are going for free. So customers can come and then buy more from us because they are getting free delivery. So all those free delivery are the carriage outwards, because people come and buy from you. You carry the item to their business for them, carried outwards, which is also an expense. So it's part of your selling and distribution expenses, which must be added. So let's also give that one a figure, say 900 within the year. So this is the total selling and distribution expenses. So let's add all of these three and then represent them here to know the total. So 300 plus 1,100 plus 900. That is 5,000. So a total of 5,000 Ghana cedis was incurred for selling and distribution expenses. Now let's go to general and administrative expenses. General and administrative expenses. We have salaries. So salaries has to do with the amount that you pay to your workers, right? As an organization, you have a lot of human beings that you work with, and you have to pay them. So what you are paying them becomes a cost. So let's say there's a salary of 8,000. You pay a salary of 8,000. You have to also present that one. You have depreciation. Depreciation in accounting means the reduction in the value of tangible fixed assets. And depreciation is a topic on its own that we will trace later. So when you buy an asset, as you continue to use the asset falls in value. And so that reduction in the value of an asset becomes a business expense. So that by the time the asset expires, you may have charged all this depreciation for you to be able to capture the consumption of the asset in the determination of